I know from our viewers at Kitco, there's a lot of frustration right now in the gold space in regards to prices, and people are just really waiting for a breakout here. So I hope we can tackle some of these issues. Gold has really not managed to break beyond 1,400 here. So what is it going to take to get out of this range? Doug? Easy question to answer,
sure,
right?
Right. Where's the gold price going? It's interesting. Actually, the gold price has, I think, done well over the last several years. We've had a nice progression. Despite what's going on in the overall markets, gold is doing what it's supposed to do. It's rising. Volatility is down in the gold space, and perhaps that's frustrating for many. If you look at the gold price, it's really set by the COMEX traders, and they are using gold for a variety of different reasons: liquidity, hedge strategies, and whatnot. But clearly the gold price is on the rise, and I think the challenge is really to get through 1370, and then we can get into the $1,400 price
and I
level.
think that's a good point, because I think we tend to forget the days of before $1,000 gold. So, Shayne, I see you grabbing the mic. Do you have any thoughts on that?
I was just going to add that I agree that gold has held in there, especially above 1,300, despite now a rising dollar. We'll see where that goes. But I think the precious metal space overall remains quite depressed, with stocks overall doing poorly, silver underperforming. So I think I agree with you, Doug, that we've already bounced maybe 5 or 6 times against 1360 or 1370, and that's the resistance we need to break through to see a really good return. But I think one thing that's been surprising on the positive side, not only that gold is held above 1,300, but that it did not go down in March and April, which we often see. So I thought that was quite encouraging this year.
Why do you think it was able to resist that?
I think a lot of it was mainly ETF buying. ETF holdings globally have been climbing very steadily for quite some time. So if you look at just the chart of overall ETF holdings globally, there's a Bloomberg ticker for that, you can see that it's been climbing very steadily. So that's highly correlated. The ETF holdings is highly correlated with the price of gold.
And that's a really good point. Yet we're not seeing that on the physical buying, though, right? At least in North America. Is anyone? Ian?
Well, that's my bad.
I believe so.
Is that better?
Yeah.
What you're seeing right now in the gold and silver space is complete and utter investor disinterest in the entire sector. If you look back to 2016, when a lot of people made a lot of money in this sector, there was quite intense activity. What you're seeing now is nothing, and the investors seem a lot more interested in buying tech shares or various other forms of investment. And until we start to see some breakout in the price of gold and silver, we suspect investor disinterest will just remain. People have been burnt so many times in this sector that they want to see sustained evidence that the price is going up before they want to get involved again, I think.
So you think that the crypto play has taken some of that thunder away from gold?
No, I think it's, if you look at the investor scene, I think a lot of the, I want to class speculators or investors, private investors and institutional, are more and more concentrated in tech stocks now. Than you've got all, if you look at the S&P, sorry to diverge a little bit, if you look at the S&P as a ratio of US GDP, it's Warren Buffett's favorite measure. It's at almost at an all-time high. And one of the signs you look for a top in the market is more and more concentration into fewer and fewer stocks, which is exactly what you're seeing right now. Loads of people all in Google and Amazon and all these stocks. So you're putting in place all the conditions are there for quite a major setback in general equities. Jamie Dimon yesterday saying 10-year treasuries are going to go from 3% to 4%. Well, if he's right, and I think he probably is, everybody today who sit their own treasury bonds is going to lose money. So if you're going to lose money in equities and you're going to lose money in bonds, people are going to start to look for other things to invest in. And that's when we think the catalyst will be to return some interest to this sector. But all the time people are making more money in other sectors, this disinterest is probably going to stay.
Good point. Vince?
To the points about cryptos stealing gold's thunder and what have you, I agree with you. That's not the case. If you look at the markets, the physical bullion market is $3 billion or $3 trillion. I'm sorry, and to own it, derivatives notwithstanding, the equity markets are about $700 trillion, and the crypto market is about $1 billion, 700 million. The point is that the headlines may be being stolen, but it's not competing with gold, although the marketing of the mainstream media would have you believe otherwise. And to your point about gold making lows in March and April, there is a seasonality in gold that it does frequently make lows in the March, April time, and that would be historically, if you're trading the market, a time to buy for at least until August. Unfortunately, and that's the flip side of us not making the low in March and April, we're making it in May, which is disconcerting in the short term, but for me it means nothing in the long term. I hope that adds to what they're saying.
And just to add to that, and I'll ask you this, Chris, I think this was a news item that got some attention, at least on Kitco we covered it, but it kind of fell below a lot of people's radar. In March, John Paulson's hedge fund removed client capital from its gold fund, essentially closing the fund. Do you think this sent an important message to the gold market, or was it ho-hum for you, Chris?
Well, I think it's just reinforcing what everybody else here on the panel is saying. It's just that there's no interest in gold, no interest in gold mining right now, and it is what it is. I mean, hopefully it's the mark of a low. I wouldn't imagine that if he were getting tons and tons of interest from outside investors that he would have said, okay, boys, we're all done. So I just think that, we're at this phase now in the market where it just seems like malaise has just gone to absolutely a comatose state, like just tired to just barely on life support, which is fine because everybody's waiting around, but for the gold stocks to move and for gold to move, but it's still hanging in there, like despite like Shayne was saying and Doug was saying, like despite the fact that no one cares, it's still at 13. Yeah,
in spite of apathy,
it's still at 13. It's still at 1320 or 1350.
Right. So we essentially need a rally here to bring excitement back into the space. But if we look at mining stocks, a lot of people would argue, well, this is a fantastic buying opportunity right now. So shouldn't that be creating excitement? Vince?
I'm a generalist when it comes to mining stocks, and others can speak more to it. I think mining stocks have a couple problems, and if you believe in general that mining stocks are undervalued, I would agree with you. The question is, how long can you wait for them to be properly valued? If the anchor is the valuation of the stock and the rope is the tether and the price is the boat never floats over the anchor. And that's because of, and that's voiced in frustrations by Paulson exiting the market because, yes, they are undervalued, but where's the catalyst that will get them to where they should be? For some, it's a rally in the price of gold because many of these miners don't hedge properly. And they want to be a proxy for gold to satisfy investors. For other miners, a rally in gold won't help them because they run their company like a business. And there's lower lying fruit, and when people like Paulson pull out of gold, and it may be a low water mark, fingers crossed, they're triaging to go to their core competencies. And his frustration with mining companies, somewhat warranted and somewhat not warranted, is well known. I think miners don't get their message out enough, and have, as a result, have been pushed aside on the mainstream media. I mean, when's the last time you saw a miner come up after Maria Bartiromo says something on CNBC?
Well, they're not given the chance. Maybe they're not getting booked on the show.
Exactly.
Right?
They
That's
don't
part
want
of
to
the
pay.
problem.
Well, they don't want to pay the money
Right.
for
So
the advertising.
mainstream media likes gold when gold's rallying, right? So they don't want to talk to the mining CEO when it's just not moving. So
They hate it less.
yeah.
I think there's another point that many of us are well aware of, and that is a change in the structure of asset management itself. And what I mean is this: alpha is very scarce in asset management, meaning outperforming the markets, is growingly difficult. I mean, just for broad indices, especially U.S. indices. And because asset managers are evaluated with greater frequency, they used to be evaluated, say, every quarter, every 6 months, every year. Now they're evaluated on a month-by-month basis. So when they think of the prospect of investing in, say, a gold miner, and they see what happens when a gold miner gets it wrong, like Detour recently, like Pretium not so recently, they really don't want to roll the dice on gold miners, and they're waiting for the industry to gain some traction before trying to take on the risk of buying something that obviously has value. I mean, mining shares are incredibly depressed in terms of valuation, and yet no one really wants to take the risk right now until we have some clearer signs.
Doug?
And if I could add to that, I think that's a good point. I think maybe even to the first question of what's keeping gold down is that there's a reluctance to participate in the space because of the past, say, 7 to 10 years of capital destruction. I think if you saw the gold price go to $1,400 to $1,500, you'd see a lot more interest. Obviously, you have a rising gold price, but I think maybe the more important point for the miners is that they're making money now. This is a decent gold price for the miners. And in Australia and Canada, those are good gold prices. There's nothing wrong with those gold prices, those profits. But they're not outsized type of profits that investors expect from a gold price move. And so we would really need a $1,400 to $1,500 gold price to get the market, more interested in the equities.
What happened if more gold companies started paying dividends?
I think that would certainly help, and you're beginning to see that recognized by the marketplace. Newmont raising their dividend.
Right.
I talked to a client last week who was very disappointed in the performance of their investment, and they said, well, why don't you guys issue dividends at least as a return? I said, well, that would be nice, but none of the companies we're investing in really have sufficient dividends to share with our clients, with our investors. So I think companies have to recognize they do have to return capital, and not just the stock price appreciation.
Yeah, that's a good point. Ian, do you have anything to add there?
No, I mean, I think we all seem pretty much in broad agreement, to be honest. The only point I'd add is that during this sort of retrenchment phase, if you want to call it that, a lot of these companies have been getting their act together with cutting down their costs, and they're in pretty good shape. I mean, we met recently with a lot of Canadian mining CEOs who came over for the Zurich Gold Show into London, and every single one that we met seemed to be in materially better shape than they were a year ago, and yet the share prices are lower. So they feel a bit frustrated. They're not being rewarded for the sort of bits of good work they put in. And also, in the medium-term space where we tend to invest, we don't tend to buy too many exploration shares or the big market caps. They're all spitting off free cash flow. And they're all spitting off free cash flow in quite decent amounts as well. So when we heard earlier that if companies want to do M&A, they've got to borrow money from the bank or raise it from a royalty company or issue more debt, there's a fourth alternative, which is they start to do it at their own free cash flow. And that's why I think you'll see the M&A kick off in the small to medium sector rather than the big, because they're starting to spit off free cash flow in a way that the sums they're spitting off is not a million miles away from starting to trigger some of this M&A. So it may be always the industry that triggers the first buying in this sector rather than the outside investors.
Chris, you're nodding in agreement.
I mean, I agree. Again, like Ian said, I think we're all in pretty good agreement. And especially with what Doug was saying in terms of once the gold price goes, right now the stocks that are doing well are stocks like Royal Gold, which is generating a lot of free cash flow. It's a low risk investment in the gold mining sector, and Newmont is actually doing pretty well because it's generating free cash flow. So I think that once the stocks that generate free cash flow are going to do well, and kind of to Doug's point is that if gold goes when gold goes through 1,400 and they lots of companies start generating free cash flow, then lots of stocks are going to start doing really well.
Is the same hold true on the silver front? We see a lot of the silver companies like First Majestic beaten down from where they used to be. Is this an opportunity to make money here?
I think with silver, so the gold to silver ratio is at one of its highest. It's really, really high, whatever, 85 to 1 now,
80,
right?
yeah.
And the mean is, say, 70 to 1. I think that, yeah, like silver is, my view is that silver is the poor man's gold. It's more of a retail kind of instrument, retail in the U.S., and that if gold goes through 1,400, or again, when gold goes through 1,400, I think that silver will catch up pretty quickly. And so, that ratio will revert more towards its mean, and the silver stocks will do well. Yeah.
Sorry, Vince, did you want to say something on that? Or?
About silver languishing, as a person who's, I have more history in silver than in gold, actually having taken delivery. It seems that the producers or the commercials that handle the producer hedging, between 18 and 1850 is where they unload. And that also coincides with the commitment of traders being, overtly long on the speculative side. And you get that cap. I think silver languishing now, I'd hesitate to put a pin on it, but I think it could be not necessarily bearish for silver, its behavior, but bullish for gold. And by that I mean gold is money. Gold is being remonetized de facto, although not officially. Silver is not. Now, silver can be a proxy for gold, as the ratio suggests, but central banks don't buy silver, they buy gold. And I think, in the worst case scenario, you're seeing gold slowly become remonetized, although it'll never be labeled that way. Whereas silver is industrial and is permitted to sink while central banks are accumulating gold. Silver will track gold if gold rallies, no doubt about that. But I don't know that the ratio is going to hold true.